So I guess the most basic question is, how did all what we've seen go on with the banks, starting with Silicon Valley Bank, but then going on, how did it change your business?
You know, for the time being, I think the immediate effect is it's actually taken the banks out of our businesses in a lot of ways, so it's made our business easier. A lot of the capital that we bring, particularly in private credit, competes with and/or is operating below where the banks are lending money. So if they're less aggressive or they're less in a risk-taking posture where we have capital and we have dry powder to invest, it makes life a little bit easier in the short term. I think the counterpoint to that is we borrow money from the banks to supplement the equity capital that we raise for our funds. So if availability of credit at banks is more difficult, that can make things more difficult for us. And I think the good news for Ares is we're a large player. So we're borrowing money from the banks across our credit businesses, across our real estate businesses in a whole variety of different ways. If they're going to vote to withdraw from the system, we're hopeful that they don't vote to withdraw from us. We hope that they're withdrawing from smaller players.
We've already seen a significant growth, some would call it dramatic, in private credit already. Since the difficulties with the banks, do you see the major banks pulling back more than they had before?
You know, the major banks at the end of the day are more inclined to be in what we all refer to as the moving business these days. And we think of ourselves as being in the storage business. So we underwrite loans and investments in companies to hold them for 3, 4, 5 years on the private side. Typically the banks and the transactions that we're competing with, that they're most interested in are big deals that they can underwrite, they can syndicate, and they can sell to investors. So it doesn't have a huge impact for the time being.
Valuations and some of the things that have been invested in with this that have changed because of the increase in the interest rates as well as some of the other uncertainties. What about the risk of loss on some of the credit?
Yeah, I mean, I think, valuations of any asset tend to correspond to interest rates. When things are more expensive to finance and/or credit is more difficult to access, the price of those assets go down. Doesn't matter if that's a company, commercial real estate, residential real estate, almost any asset just devalues. And that's obviously what we saw last year as rates rose, I think, more quickly and in a more extreme way than anyone might have expected 12 to 18 months ago.
Do you expect more defaults?
On the default side, I think I'd say yes, broadly, because despite the fact that we actually see fundamental economic performance in companies and in the overall economy to actually be pretty good, you have plenty of companies out there that have taken on debt, real estate owners that have taken on debt with the assumption that they could live off a base rate of 1%, and now they're dealing with a base rate of 5%. So even if the asset's performing, the cost of servicing that debt is substantially higher, their cash flows are substantially lower, and they need to plan a little bit differently. The companies that aren't performing are still dealing with that higher cost of financing, and if you're not performing and your interest costs have soared, there's a higher likelihood of default.
Those of us who know your business the way you do tend to think a default, that means a loss. Not necessarily so.
Definitely not. So defaults in the leveraged credit, the leveraged real estate lending business are kind of part of the game, and they just come and go with cycles. The key is it's the beginning of a discussion. Things aren't performing to plan, so there's a default. Does that mean that the company's worthless? Does that mean that the loan is bad? It doesn't. So we, as lenders, in a lot of situations, work with owners of properties or of companies to figure out how do we resolve the default. How do we get that asset position to grow into the capital structure? Perhaps more equity has to come into either the project or the company. And then you start thinking about loss mitigation. The first thing that happens is the equity return gets challenged, right, with underperformance and higher debt service costs. It tends to be that the creditors who have the most room, for underperformance get to begin that negotiation. But for us, it's all about managing those losses and trying to reduce them in the future. Defaults are just, I don't want to say they're ordinary course, but when the economy slows and rates go up, they become a bit more ordinary course.
Before we saw any difficulties with the banking system, there appears to have been a shift, perhaps in market share, between the traditional syndicated loans from the banks on the one hand and credit on the other. What are the causes for that shift, and are they likely to continue? I mean, how far do we go with private credit in your judgment?
Yeah, I think so. I mean, if you look today, we think in the U.S. private credit markets, it's about a $1.2 trillion installed base market. It's grown every year over 20 years, and it's grown as the banks have de-emphasized, in particular, smaller transactions in the middle market. The middle market used to mean 100 million of EBITDA and below. The reality is today, in direct lending and private credit, the multitude of capital raising there, and I think also the value of the solution that we provide has become more and more attractive, and the returns have been good for investors. So that virtuous circle has compelled more capital in, larger participants in the space, and the ability to do larger and larger transactions. So I think we in that market offer more value as a lender than we ever have, and I think that will continue. It's these periods of time that really tend to demonstrate our value, where again, we're coming in as a partner, we're coming in to underwrite and own a loan, not to sell it, not to syndicate it, and be there to support a company's long-term growth. Very often we do that with sponsors of companies, private equity firms, sponsors of real estate projects, et cetera. So they care about the cost of capital, but we found that more often than not, they're willing to actually pay a little bit more to have that customized, flexible approach with a partner that they feel can scale with their expectations for their investments.